Let me ask you something real quick. If I gave you $100,000 right now, not a loan, not a catch, just handed it to you, what would you do with it? I've asked that question to a lot of people, and almost every single time, the answer is the same. I'd buy a rental property. And honestly, I get it. Real estate feels safe. Real estate feels smart. Your parents probably told you to buy property. Your friends talk about their rental income like it's some kind of superpower. And every other YouTube video makes it look like a shortcut to a beach house. But here's what nobody tells you. The numbers, the actual cold, hard numbers, don't always back that up. And today, I'm going to show you exactly what I mean. We're going to compare real estate and stock market investing head to head. We're going to look at real data, real returns, real costs. And by the end of this video, you're going to walk away knowing where the money actually is. Let's go.
Part 1. Why everyone thinks real estate is the answer. Okay, so first, let's be fair to real estate, because there's a reason people love it so much, and it's not just emotion. When you buy a rental property, something kind of magical happens. You put down, let's say, $60,000 on a $300,000 house. A tenant moves in, they pay you rent every month, that rent covers your mortgage. And over time, the house goes up in value, and you own the whole thing. That's called leverage, and it's genuinely powerful. Think about it. You put in $60,000, and you control a $300,000 asset. If that house goes up 10% in value, you made $30,000. That's a 50% return on your actual cash. No stock can do that, right? And there's more. Real estate gives you tax advantages. Depreciation, mortgage interest deductions, 1031 exchanges. The IRS is weirdly nice to real estate investors. You can defer capital gains for years, sometimes forever. And then there's the psychological part. You can touch it. You can drive past it. You can say, I own that building. That feeling, it matters to people. It feels real in a way that a stock portfolio doesn't. So, okay, real estate has some serious points in its favor. I want to be clear about that. But now, let's look at what actually happens when you run the numbers.
Part 2. The raw data. What the numbers actually say. Let's talk long-term returns, because this is where things get uncomfortable for the real estate crowd. Over the last 30 years, the S&P 500, which is basically just an index of the 500 biggest US companies, has returned an average of about 10.3% per year, including dividends. Some periods it's even higher. Real estate over that same period, an average of around 8.8% per year, including rental income. Now, on paper, that doesn't sound like a massive difference, right? A couple percent, whatever. But compounding is brutal over time. Let me show you what that gap actually means. Let's say it's the year 2000. You have $34,000. That's the down payment on a median-priced house at the time. And you have a choice. Choice A, you put that $34,000 into an S&P 500 index fund and you don't touch it for 25 years. Choice B, you buy the house, rent it out, deal with tenants, deal with repairs, deal with everything. Guess what happened to the $34,000 in the stock market by 2025? It turned into roughly $225,000. Hands off. No phone calls, no burst pipes, no problem tenants, just compounding. And the house, it also did well. Depending on the market, you probably built solid equity, got rental income, used leverage. It wasn't bad. But here's the part most people skip past. That stock market number assumes you did nothing. No management, no maintenance, no vacancies, no nightmare tenant who stops paying rent in January and you can't evict until April because of local laws. The stock market just worked while you slept. And that's not even the biggest hidden secret.
Part 3. The hidden costs nobody talks about. Here's where real estate gets messy. And I mean that genuinely, because most YouTube channels just skip this part. When someone shows you real estate returns, they usually show you the gross number, the price the house went from and the price it went to. Maybe they add in rental income. but they almost never subtract what it actually costs you to own that property. Let's run through it. First, maintenance and repairs. On average, you should budget about 1% of the property's value per year just for upkeep. On a $300,000 house, that's $3,000 a year, every year. Hot water heater breaks, roof needs work, HVAC goes out. These things happen, and they're expensive. Second, property taxes. In most US states, this is somewhere between 1% and 2% of the home's value annually. So another $3,000 to $6,000 a year, gone. Third, insurance. Property insurance, liability coverage, potentially landlord insurance. Add another $1,500 to $2,500 depending on location. Fourth, vacancy. Unless you have the world's perfect tenant, there will be months where the unit sits empty. Industry average is about 8% vacancy per year. That means roughly 1 month out of every 12, you're not collecting rent. Fifth, property management. If you hire a manager to handle it, which most people eventually do because dealing with tenants is genuinely exhausting, that's usually 8% to 12% of your monthly rent. On a $2,000 per month rental, you're handing over $200 every single month. Now add all that up. We're talking $8,000, $10,000, maybe $12,000 per year in expenses on a single property before your mortgage payment. And suddenly that rental income that seemed so passive, it's not that passive anymore. Compare that to index fund investing. The fees on a basic S&P 500 index fund are around 0.03%. On $100,000 invested, that's $30 a year. That's literally the cost of a nice dinner. The stock market doesn't call you at 11 p.m. about a leak. It doesn't have vacancies. It doesn't get evicted. It doesn't need a new roof. It just compounds.
Part 4. But wait, real estate isn't dead. Okay, now I want to be honest with you, because I'm not here to trash real estate. That would be lazy and it would be wrong. There are real scenarios where real estate absolutely dominates, and you deserve to know what those are. Number 1, the leverage game, when it works. If you bought real estate in 2012 or 2013, when rates were low and prices hadn't fully recovered from the crash, you crushed it. That leverage I talked about earlier, when the market moves in your favor and your rate is locked in at 3%, you are printing money. The stock market can't give you that kind of amplified return on your own capital. Number 2, local market expertise. Some people genuinely know their city. They know which neighborhoods are about to pop. They buy a duplex in an up-and-coming area, live in one unit, rent the other. House hacking, they call it. That's a real strategy that can dramatically accelerate wealth building for people who are willing to do the work. Number 3, REITs. And this one is interesting because it kind of bridges both worlds. A REIT is a real estate investment trust. It's basically a company that owns real estate. Apartment buildings, office towers, warehouses, and you can buy shares in it like a stock. REITs in 2024 paid out an average dividend yield of around 4.1%. That's real cash income, paid to you quarterly or monthly. And you don't have to fix a single toilet. So if you love the idea of real estate, but you don't want to be a landlord, REITs are worth a serious look. Number 4, inflation protection. Hard assets like real estate tend to hold their value when inflation runs hot. When the dollar loses purchasing power, your rents can go up, and your fixed-rate mortgage stays the same. That's actually a beautiful hedge. So real estate isn't bad. It's just not the simple, obvious win that people act like it is.
Part 5. So who wins? The real answer.
Okay, so who actually wins? Stocks or real estate? And here's the honest answer. It depends on you, but the data leans one way. For most people, most regular people who work a job, who don't have deep knowledge of a local real estate market, who don't want to deal with tenants and contractors and property managers, the stock market is the better, simpler, more powerful wealth-building tool. It has lower costs, it's more liquid. If you need money tomorrow, you can sell shares tomorrow. You can't sell half a kitchen. It's more diversified. And over long periods, the compounding is relentless. But here's the thing top financial advisors will actually tell you. The ideal answer isn't either or, it's both. A Cornell study found that optimal portfolios include around 9% to 20% in real estate. Not zero, but not 100% either. The sweet spot most wealth advisors suggest? Something like heavy index fund exposure as your core. Think S&P 500, total market funds, and then a slice of real estate, whether that's direct property ownership if you have the capital and the risk tolerance, or REITs if you want the exposure without the headaches. The people who build real, lasting wealth usually aren't picking one or the other. They're building systems. They're diversified. They're not putting everything on red. And that's the truth nobody tells you in a clickbait real estate video.
Part 6. The stuff to actually do right now. All right, so let's make this real. What should you actually do with this information? If you have money sitting in savings doing nothing, look at a simple S&P 500 index fund. Vanguard, VOO. Fidelity, FXAIX. iShares, IVV. Dead simple. Low cost, just start. If you're interested in real estate but don't have the capital or the stomach for being a landlord, look at REITs. VNQ is the most popular real estate ETF. It gives you broad real estate exposure for the price of a single stock. If you do want to be a landlord, run the full numbers, not just the rent versus mortgage, all of it. Maintenance, vacancy, taxes, management. Make sure the numbers work even in a bad year, because bad years happen. And whatever you do, start. The biggest mistake isn't choosing the wrong investment. The biggest mistake is doing nothing while time passes. Compound interest works for you or against you. Choose which side you're on. So, real estate or investing? Here's what I want you to take away from this. Real estate can build wealth. The stock market can build wealth. But neither one is magic. Neither one is a shortcut. What actually builds wealth, what consistently separates people who retire early from people who don't, isn't the asset class. It's the habit. It's the consistency. It's the willingness to put money to work and leave it there. The real money isn't hidden in a property or a portfolio. It's hidden in the discipline to keep going when nothing feels exciting. If this video helped you think about your money differently, hit that like button. Subscribe if you want more of this kind of real, data-driven finance content. And drop a comment. Are you team real estate, team stocks, or somewhere in between? I read every single one. I'll see you in the next one.